Hey everyone, I'm going to go over a method I'm considering using to get into Seritage Growth Properties stock at effectively a discount. And it's something that you could use for other stocks as well. I'm going to go over that in this video today. Now the stock in question, Seritage Growth Properties, ticker symbol SRG, is a REIT that effectively is all of the properties that Sears had, Sears being the company in bankruptcy right now. So it's all of their old properties basically. You got large parking lots, large empty retail spaces, and just a lot of land and properties in general. They fairly recently went through a change in management in an effort to try and unlock some value out of these properties, and they definitely have some promising projects in the works. However, it's a pretty tall order. They have a pretty big debt load as well, but I'm not going to be getting too much into the fundamentals in this one, as there's been some pretty comprehensive research here on YouTube already that really goes into some of the value potentially in SRG, and it's one of the big reasons I'm interested in it. I'll include some of those videos in the description below if you're interested, but for now, I really want to go over the method I would be using to get into SRG most likely if I end up doing it. Let's hop on over to my screen, and yes, this is Robinhood, and I'm using it for this example because the interface is really nice and it's easier to explain here, though pretty much any major brokerage should allow something like this. So anyways, here's the regular stock. You can see it's trading at $9.22 a share. This is Sunday as I'm filming this, so we'll see what happens through the week. It's been pretty volatile over the past month. You can see going up and down pretty violently, as high as almost 11, as low as it got below 8. Yeah, $8.36 just a couple days ago. So big swings after an already sharp decline down when we were heading into the pandemic, and it really has not recovered since those pre-pandemic highs of something like $38 a share. Again, I mentioned they have a lot of debt, so that's worrying investors, and they're trying to do a pretty hefty redevelopments on a lot of properties, so that's going to be expensive. There's risk in this position is all I'm really trying to say. But over the past couple of years, it's gotten as low as around $7, I believe. Yeah, $6.68 we saw right there. It got as low as that, and actually as high as 23 back in March of last year. So 1 year after the pandemic began, and if we fast forward another year, we're all the way back down to about $9.22 per share. So it's been a bumpy ride to say the least. But now let's get into this strategy and how to get SRG at a potential discount, or really any stock for that matter. And we're going to go on down here to trade SRG options. Yes, this is an option strategy, but before you click off, we're not talking about your YOLO gambling type options, but something that a value investor in particular could potentially take advantage of. So in this case, I'm interested in buying SRG shares. So I'd want to go down here to sell put, which means I would be selling or writing a put option. And I'll explain a little bit more on how the mechanics of this would work. But let's go on down here to the $8 strike price. Actually, first, I'm going to change the date up here to January 2023. So this would be just under a year from now that these options would expire. And if we go on down here to the $8 strike price put, I could sell one of these options for $1.73 per share, but because there's 100 shares in an options contract, that would really equate to $173 that I would make by writing this option. What I mean by writing an option is I am giving someone else the right to sell me their shares, in this case, at $8 before January 2023, assuming that SRG actually falls below $8 per share. So to clarify, if I write or sell this option, I'm giving someone else the right to sell me their SRG shares, 100 shares, at $8 per share, assuming it falls below $8 in the first place, and assuming that happens before January 20th, 2023, which is when this option would expire. And in exchange for that right, I'd be getting $173 to do that. So you're getting a fee up front in that sense. So that's the overarching mechanics here, but what exactly does the trade entail? In this case, I'd have to put up $800 in collateral. And that's because I need to be ready to buy 100 shares at the $8 strike price, because that's the right I'm giving to someone else. If it falls below $8, they're going to want to assign that contract where they're going to sell me 100 shares at $8 per share, even if the stock is trading at $7 or $6 or wherever it falls to. And that's assuming it actually falls to that level at some point before the expiration date. But either way, I'm putting up the $800 in collateral. But remember, we're collecting that $173 up front, that sort of options fee, that options premium, because we are writing this option for someone else to potentially exercise against us if all the conditions apply. So we have the $800 in cash that we've set aside as collateral up front, but we also have the $173 that we're making upfront in premium. So that is money to us rather than money that we have to set aside. So let's go over the potential scenarios here. What happens if SRG goes up or down, and whether it actually hits the strike price or not, and whether we get assigned the shares or not. So let's see what happens if SRG goes up, or in this case stays sideways. It doesn't hit that $8 strike price. Well, Robinhood does give you this handy chart down here, and this point right here is $8 per share, the strike price. Everything over here would be anything above that. So if we reach January 20th, 2023 and the stock price is above $8, we effectively just got to keep the $173 in premium, or in this case, $170. It rounds down since I don't think you can actually sell the option for that much. You have to do it on a round number. I believe that's how that one works. But that would mean that the option that we wrote for that other person expires worthless. So they gave us the fee up front and they never got to exercise it, which means that your collateral would thus be untied. It would be free again. And you got to keep all that premium. You didn't have to do anything to close the option or get forced to buy the shares. So in that way, you basically made $170 on the $800 in collateral, and that's the whole trade. And if we pull up a calculator here, that would equate to $170 in profit over $800 in collateral tied up, which would mean that you'd make about a 21% return over those 11 months or so, assuming you opened up the trade today at these exact prices. So you actually would have made 21% without actually owning SRG at all. And this is if SRG never comes down to $8. It stays above $8 until January 20th, 2023, and you're never assigned the shares. So ideally, that's easy enough to understand. If SRG never falls to $8, then you're making that 21% or so over 11 months, and that's your return, and then the trade is done. But what happens if SRG falls below $8 before our expiration date? Well, we could take a look at this chart again, which is pretty handy. $8 is where you would potentially be getting assigned, and generally if it falls below $8 at all, you're probably going to be assigned almost certainly, at least if it's anywhere close to your expiration date. Well, notice where your actual break-even price is. If we go all the way down to $6.30 per share, that's where you'd actually be making $0 on this trade, which is quite a bit lower than where it's at right now. It's at $9.22 per share. So it'd have to fall another $3 for you to actually hit your break-even number, where you're not making any profit here. But you're owning 100 shares of SRG, which if you wanted to buy SRG in the first place, you're effectively buying SRG at this discounted price of $6.30 if you want to look at it that way. Because you're forced to buy the shares at $8, but remember, you wrote that option. So in that way, because you're collecting that option's premium up front, if you actually are assigned the SRG shares and you have to buy them, you would effectively be getting them at a discount because you collected that premium up front. But you might be saying, hey, wait a second, what happens if SRG keeps falling and it goes all the way to zero, it goes bankrupt or something bad like that? Well, in that case, you would still have the same equity downside risk. Because remember, if it falls below $8, the chances of you getting assigned those shares is extremely high and pretty much certain if it's anywhere close to expiration. So if that happens, you're assigned the shares and you're effectively a shareholder at that point. If anything happens that would trigger the stock to fall way below $8, you still would be exposed to that sort of risk. But in this case, I'm assuming that you would want to buy into SRG at the $8 strike price. So instead of actually buying outright at $8, you write this option instead, so that if SRG does hit that $8, then you'll go ahead and have to make the purchase once the contract gets exercised and you're assigned those shares. But if you were willing to buy at the $8 share price anyways, how much of a difference does that really make? In this case, at least you're getting some profit right up front by writing the option. Now, the other big risk here, besides the general sort of equity downside if it falls below $8, you still would have the opportunity cost of holding onto this option and tying up that collateral. Maybe there's another opportunity that you want to go for. Well, in that case, if you're trying to close out the options position, you're actually going to have to buy it back. And at that point, the option contract might be more expensive than it was before. It depends on when you're buying it and how much the price has moved, and also what implied volatility looks like, which is sort of like a pricing metric for options. But what I'm trying to say is there's a chance that the options contract becomes more expensive and you're going to have to bring some money to the table to actually close it out before you can get all your collateral back. So that's something to keep in mind as well if you're not looking to hold till expiration or wait till the stock hits that strike price and you just get assigned the shares. But anyways, that's the strategy. I'm by no means suggesting that you do this method, but it is an interesting tool, especially for value investors who might have a particular price target for a stock, especially one that's going through some volatility right now, where you could potentially make a pretty decent premium by writing some options, assuming you really want to buy the stock at a particular price, and you might as well take that premium up front if there's not somewhere else that you want to put that collateral towards. Now, I will warn that options can get complicated very quickly, and you can get yourself in some serious trouble if you do things incorrectly, so be sure you know what you're doing, do your research, and figure out what exactly you're being exposed to when you actually open up an options position. Now, ideally, this was a clear enough breakdown, but if you're still confused, then definitely check out my options primer, where I really go over the basics of how to use this sort of strategy, both on the buy and sell side for stocks that you might have a particular buy or sell target price for. I think it's an especially useful strategy for value investors who have a specific intrinsic value in mind on a particular stock, in that you can make some extra income while you wait for those stock prices to move. I'll go ahead and link that on the screen above as well as below in the description. But otherwise, if you guys want to use Robinhood, which is the brokerage I used for this example, definitely check out the affiliate link in the description below. If you open up an account there, you get a free stock, I get a free stock, so it's a win-win. But of course, you could pretty much use any brokerage that you're comfortable with that allows options trading. But otherwise, if you guys liked this video or found it informative, then definitely like it since that would help the channel out a lot. And if you want to see more content about personal finance and investing, then definitely subscribe since I put out new videos every single week. But until next time, take care.